We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is a new guest to the show, Killian Connolly, Director at Price Value Partners. Thanks for joining me today, Killian.
Hey, Tom.
So you focus on value investing. And I want to start by asking you, why is it that you focus on value, and what are the main differences between growth and value investing?
It's I guess, why do we focus on it? And I think that's more by our personalities. The guys, Tim and I, set up the business, and I think, we were managing money for a different firm and meeting clients. And I think when performance isn't ideal or in line with benchmarks or whatever, you've got to stand in front of people and you've got to explain why something is down and you're still holding it. And you've got to stand there in front of people and give your investment thesis, not just in the good times, but in the tough times as well. And I think we just gravitate to explaining, okay, well, this is a company that's generating a lot of cash. It's not overly indebted. If the share price fluctuates, that is life. And if we're underwater, that's part of the investment practice as well. But I think we gravitate that we think, say if you find a good investment or whatever, and then you think about it and you decide to buy it, you talk to clients about it. Our thesis is like, all we need is this company is to continue operating as it has been the last 12 months. Mm-hmm. We're not factoring in high growth in cash flow or anything like that, or revenues. We're just saying if it does this for the next 12 months, we're going to make a lot of profits. The company's going to generate a lot of cash, and the sentiment by and large will start. The way that sentiment is generally, it ebbs and flows, and it's usually a function, primarily, we think it's a function of margins. So sometimes margins come under pressure. And if anyone who runs a business, we run one ourselves, we haven't a clue what our margin's going to be for the next 12 months. Haven't a clue. We just accept it, right? We're trying to stay in business. We're trying to grow the business, deliver a good service and product to our clients. So you're going to see ebbs and flows. In an actual fact, when you see a company with really steady margins, they generally apply a lot of debt to that model, and then you get really bad outcomes as well. So for us, it's kind of like, why are we value managers? It's wholly because of who we are and the way we want to manage our own money and want to manage clients' money and stand in front of them. And then how do we define the difference? And we can touch on some of the metrics we use, but we're looking for a 10% cash on cash return. So that's what we call cash flow from operational yield. And if you're buying a growth stock like Amazon, there's some great growth companies, Amazon, we all know the ones that are generating a lot of cash, they aren't heavily indebted. If you buy one of them, you've got to stand in front of the client and explain how that cash flow is going to grow. You've got to kind of come across as the best analyst out there. You've got to show a level of confidence. You've got to do all that analysis. And in the end, we think, whatever the biblical term is, he is fallible. And I think it's so hard, again, as if you run a business, it's so hard to predict outcomes. When we set up this business, Price Value Partners, it in no way was going to be like it is 6 or 7 years later. And I think even if you look at Amazon, bookstore ends up being a kind of data processor, loads of servers or whatever. And to stand there with a degree of confidence, say, this company this year is going to generate this. And a lot of these growth stocks, we're looking, the analysts are looking 7 or 8 years out and saying, this is what they're going to do. And it's like, they could do that and they've done it historically, but nothing grows to the sky. And these are the same, this growth argument has been around, it's as old as the hills. And you had the Nifty 50 in which everything was going to grow. And, it was like, it was a one option investment. It wasn't a case of whether you buy or not. It's how much do you allocate to these growth stocks? And I think that's the distinction. I think we personally just want to buy what we're comfortable buying, but also we are quite, there might be a time when you might want to be a growth investor, but I think at these valuations, it's a dangerous place to be.
So when you were saying, the sentiment around value investing, are you seeing some signs that value investing is starting to come back into the minds of investors?
Not when we pitch, no one's kind of saying, "Oh, it's great to see you value investors." it's time for me to get out of all the growth stocks. I think if you look at, I think there's a Bloomberg ratio you can do between a value index they have, and it's like MSCI value divided by MSCI growth. And we are at, I mean, the chart just dropped out after it started turning in value's favor in 99, but then since 2008 or whatever, thereabouts, it's been huge growth outperformance. When we started the business in 2015 and started trading, we would have shown that graph and said, this is the end, this is going to turn for value against growth. And then actually at the start of 2020, right, we were given a presentation in a club club in London. And we showed the graph again and we were like, oh, well, it must be turning here. And then we had a call in May with the clients and they said, oh, can you update that graph? And I said, yeah, I'll do it now. And I was on Bloomberg. And I said, do you know what? I just wouldn't be surprised if even in this instance, growth is outperforming. And sure enough, it made a new high. Mm-hmm. As in value, it was underperforming even more egregiously in the middle of this nonsense pandemic. Whereas, so it's just like, okay, this is just, we've been beaten down. Value investors have been beaten down. So I couldn't say with any certainty, we're not seeing any signs, but when there is still compelling value. There's no shortage of compelling good companies hitting our metrics or whatever. So in that instance, yeah, there's, it's, we apply a kind of a moving day average just to screen out what are kind of making a new 30-day high. There hasn't been any great uptick in the number of those stocks. So in terms of price action, I don't think we can claim a win against growth. But on that chart, you get very bullish if it was making a 6-month high or a 1-year high. But I imagine this it's not going to be, people always think of it as a rotation as well. It's not like there's some people are going to sell their growth stocks and get out to the value, and that's going to lead to the reversal of the ratio. It's just going to be, they're going to change valuations. There's going to be a bid on good cash flow generative companies with very little debt. And there's going to be, and I imagine it'd be because of inflation and a realization that this is not transitory. I think you'll see real margin pressure and real margin erosion on a lot of these growth stocks. And when you see margins collapse, share prices look out below. I think you're seeing even in the initial, I think it was it Facebook were announcing poor results, and Amazon got hit as well, down 5%, nothing, probably back above where they were. But it will matter. It'll matter at some point, and people will just run for the hills. And so that the ratio will come back, but it's not about some investors going to change their mind. I've never really bought this, wall of cash just swinging in between asset classes and causing, great upswings in some and lows. I think that might even follow some trend changes, some valuation changes. But I have no dog in that fight. All I know on some of the charts we use, if a company continues to operate well, the share price gets there. Mm-hmm. You just don't overthink it. You try and come up with rationales and catalysts or whatever, but just go and play golf. Go and do something else. Don't worry about trying to rationalize when this will happen. Just be happy that you're in a company operating well, and just wait for the share price to recognize those operations.
Mm-hmm. So before we get to kind of how you look at and analyze companies and analyze them for value, I'd like to stick with the macro picture a little bit. So sure. Given that you have a master's in economic history, what does this time of loose monetary policy remind you of most in history?
I think, and I'm probably going to given out to for going back too far in history, but in the early 1600s, King, I think it was Philip II of Spain. So even go a bit after that. So a representative of the British Mint traveled over to Spain in 1680 something or other, and he wrote a report about their monetary problems that Spain was experiencing. And this is about, he's come in at like 16, so don't quote me on the dates, but he comes in at 1670. He writes a report and he goes back in time to this 1600 period in which King Philip just decides that he's going to demonetize gold or silver, whatever it was. It was, they started, the government themselves started making these coupons and tokens, and they weren't gold, they weren't silver, they were some copper or whatever equivalent. And so there's huge monetary inflation, as in coins were coming into the monetary base. It led to periods, and I think the quote is, it led to periods of high inflation, periods of deflation. And in the end, in 1660, they went back to a monetary standard. It was too painful for the economy. It was too painful for society. And they ended up going back. And I think in this, that's all that can really happen here. And you can't invest for what this new monetary system can be. Like, I know that's why a lot of people buy gold or whatever. It's not why we buy gold. You can't really say it's going to happen in your lifetime or whatever, but it will happen and it will be forced on by society. I think in the other periods are similar in the 70s. And I think the second question or third question in the first presidential debate between Carter and Reagan was about what about the cost of living and inflation. So it becomes such a societal problem that had to be dealt with. And obviously Volcker was in there and he ended up having to hike the rates. Why I wouldn't go so far as to say that will be the outcome is because with these debt levels, and you must have guests on here saying similar stuff, but you can't you can't beat inflation this time. Mm-hmm. So inflation comes out, I think in our letter we talk about a Bank of England report that said if the base rate in the Bank of England, United Kingdom, goes to 2%, that will have more of an impact on mortgage market rates and prices of houses in the UK than it had in 2008. I mean, they're bound. We have the FOMC meeting coming up in tomorrow. The meeting's today. The announcement will be tomorrow, and you don't know what they're going to do, and they'll keep on talking it up and kind of like whatever. But ultimately, I think we're close to this inflation getting out of hand. Yeah, and I think I'd probably say it's more like back in King Philip's time. I think ultimately it probably becomes, people call it a financial reset or whatever. I wouldn't use those terms. Monetary systems change. So we had a different monetary system in 1920s. FDR revalued gold, but obviously people were coming on and off gold all the time. FDR, he gets the famous one because it was America at the time in 33. And then you had Bretton Woods post World War II. Then you had pure fiat, whatever you want to call it, 71. And then even closer to home here, as an Irishman, we had a euro come in 99, which is a complete. Now we were in a pegged currency, say, or certainly a managed currency against sterling, and before that. But then you come into the European Union and it just becomes a gold standard of its own, which is a new monetary system. So you don't need to sound outlandish by saying this monetary system is going to change. And some people on Twitter or on TV will call it the Great Reset, but it's just going to be a different monetary system. There'll be winners and losers. And I wouldn't want to be holding paper promises in that environment. So yeah, it's a long-winded thing. There is, I think Tim, my business partner, quotes something like, there's a famous book from a guy called Eamon Butler that says 20 centuries of wage and price controls, how the government never works out in their favor. Do you know there's annals and annals of history about governments trying to suppress the price of something for their own benefit or for their perceived societal benefit, and it just never works out. So, you can lead into other things. I think commodities breaking out now is interesting because it's kind of what you'd expect in this environment. But I guess we would have been guilty from over-egging the risk of inflation since 2009.
But Killian, while we're kind of on this subject of inflation, deflation, I think this is a really interesting point because everybody's so focused on inflation right now that sometimes maybe we can forget that this will kind of happen in a cycle of inflation and then deflation. So how do you see that playing out? And explain to us maybe how we can see deflation as part of this inflationary cycle.
Yeah, and it's like Russell Napier is a great economist, and he talks about there will be a deflation shock and then inflation and so on and so forth. He's actually one of the few that have flipped from being a deflationista. And then Corona comes along and he's like, no, that's it, guys. That was the deflation shock I was concerned about. Now we're into MMT, money printing. But in actual fact, it's even if you believe that this is not transitory inflation, it will have to be calmed one way or the other. Mm-hmm. It will just have to be. And that will be a huge deflationary event. So we're all like, we're positioned, we don't want to be in paper promises and all that kind of stuff. But ultimately, and that doesn't mean when the deflation comes, that doesn't mean your bonds are going to be rallying either. That's not that. It's just that if they do have to, say if you've got inflation, you've got choices there, right? You either hike the base rate or you bring in a new monetary system that allows you to actually, as an economy, but also as a state, survive in that new form. And so you don't have to go too far. I mean, Argentina are exactly, you look back in whenever they had their currency crisis, I think it was 2000. They had a pegged currency, so they had dollars and they had Argentinian pesos or whatever. Ultimately, they were printing, and there was too much credit expansion in Argentina, so the Argentinian peso weakened. They eventually had to break that currency peg, and then they had to repeg at some stage, float it, kind of, ensure. So if this inflation gets out of hand, you can hike rates, or you can just repeg to, say, gold or a broad basket of commodities or SDRs or whatever it's going to be. And then you can just revalue your old currency against your new, more harder currency. I mean, in the end, it's the governments that have all the gold bullion. So, but it will be hugely, that in that system, if it comes into a kind of a, whether you call it a Bretton Woods system, which was a very controlled monetary base in Bretton Woods system as well, that in of itself is not an inflationary period either. So if we do get runaway inflation and they somehow don't lead to kind of like a huge deflationary event, if they manage it accordingly, you could see something like Bretton Woods coming back with an SDR backing it all. That in of itself, that would be a much fairer monetary system in our view. But then you have the same political manifestations there in which people were jumping, going to the IMF or devaluing against, other currencies as well. So it's with every, I think it's called the Triffin trilemma or whatever. You can only have, any monetary system can have three. It can either have fixed exchange rates, it can have independent monetary policy, or capital controls. You just choose your poison. Mm-hmm. And monetary systems change from one to the other. So in this, if there's inflation, it may be that they don't hike rates. It just means that there's a new monetary system that comes in and cleanses the system. But I would be of the firm belief that there will be a new monetary system for sure, because I look back at history and I see every fiat currency regime not survive. But that does not mean that I think investors should invest trying to predict it. And it does not mean that I have any degree of certainty how long this current fiat system survives and what the next one will really look like. But if you look at that Triffin dilemma, it'll have to have certain characteristics. And with that kind of brings it all a little bit less, crazy kind of like, global reset kind of thing. It's just like, yeah, it's a new monetary system. There has been one, there will be one, there will be one after that as well. But I think half of it is, from a macro point of view, it's just stay away from certain asset classes because there is no economic value behind a bond or cash. So rather than try and predict it by buying Bitcoin or buying gold or whatever, just make sure you're in economic assets that will be revalued in the next monetary system as well, because they have economic value. They will naturally have value in any monetary system. Mm-hmm. And I just feel too many people are like deeply concerned about macroeconomics, about the government, about liberal issues as well. And it leads them to kind of say, okay, well, I'm going to invest on the basis of what I think is going to happen or what my moral suasion is to what should happen. And, like say if you do that and you buy gold and it's down 50%, how do you, I'm not a very good trader. I would not make money speculating in the commodities market. I just know that I'd lose it very quickly. My business partner, Tim, he's the only person that's lost money with Bitcoin on the way up and with Bitcoin on the way down. I mean, the two of us, you do not want us to be traders.
Mm-hmm. Yeah, and that's why, like you say, you focus on value. And in your quarterly letter, Killian, you write that you split your investment universe into 4 asset classes to protect against asset manager hubris and overconfidence. So how important is it to question your assumptions, and how do you try to manage overconfidence in your strategies?
Yeah, I think if you have any investment manager with a history behind them, the process is born out of mistakes as much as it's born out of good investments. And I think that part at the top of the letter there, where we specify we try to diversify because we want to be in, we don't have too much in commodities, too much in value equity, too much in trend followers. And the bond market is, and that's when we go into the letter, we just talk about, well, yeah, we have a tiny allocation of the bond market, but it is uninvested. It is, if you're unconstrained, there's better options for you out there. But I say that, and I can show you a very well operating business, very little debt, operating really well in today's environment, cheap and all that kind of stuff. I have to show you that, though. I can't just say, listen, the bond market's uninvestable. I can show you exactly the bond market's uninvestable, right? Because the yields are negative, and people are lending to Austria at negative rates or whatever. So I can show you that's an object. I think you've also, how do we get away from hubris? You've got to explain yourself as if you're talking to a 5-year-old. Mm-hmm. Because a lot of hubristic kind of like conversations and you're trying to force your opinion down on people. Whereas if you just try and educate people and say, the bond market, we think this about the bond market, and this is why, as in if you lend money to the UK government for 30 years, you get this rate of return. Do you think that makes sense? No. I think a lot of investment managers fail to even have the conversation. Like if you're talking to clients, you're talking, there's 4 of us in the company and we sit in the same room and we talk daily about everything. Sometimes it's about financial markets, sometimes it's about TV programs or whatever it is. But that dialogue itself keeps you checked or whatever. So anytime any of us is thinking of making an investment or even in their own money or client money or whatever, you've got to show, well, this company, how's it operating now? Explain to me every aspect of that balance sheet in detail, understand it. Is it cheap? All these kind of stuff. So in that sense, and that's from our good investments and our bad investments historically, the worst investments we have made have been when we've been too focused on the macro, by far. So, we've been in 2011, we were buying miners at expensive valuations, objectively expensive valuations. And we were saying, well, actually, what, gold, they're printing loads of money, gold commodity is going to go up. Okay, let's hold on to these things. And we got taught a really valuable lesson. And I think some people kind of say there hasn't been a bear market for however many years, a proper bear market. How are people going to react in that? Tim and I look at each other and said, well, if you're investing in commodities at 2012, you've experienced a bear market and a crushing one at that. So you do have that. You've learned a lot of lessons from that. And I think that's the one lesson is never take your eye off the micro part of the investment process, because that hubris, I think, comes from the macro argument. It's like, we can't do this. This is what's definitely going to happen. But then even if you like a certain commodity, if there's no value in that commodity producer, stay away. It could be, everyone hates palm oil at the moment, but there's good palm oil producers or whatever that are really cheap. So that'd be, that's not hubristic to want that. That's just like a good company operating well. So I think that's so long-winded. I think that's the way to check our hubris, is to diversify it across, make sure everything is guided from that principle of zero, little or no debt on the balance sheet, currently operating well for the last 12 months. And then we have the large allocation to trend followers, which would be, it'd be reasonably well known by a niche sector of wealth managers. But in actual fact, in the broad sphere, I'd say your average wealth manager maybe hasn't heard of trend following funds. And if he has, they'd allocate about 1% of a client portfolio to, whereas we allocate, thereabouts 20% of, we'd allocate 20% of a typical client portfolio to these vehicles. And they are vehicles that have done very well in periods of those deflationary crises. So 2008, 2000, any time in which there's been a broad market sell-off for a prolonged period of time, they have managed to deliver real strong returns on client portfolios. But they don't necessarily even need that kind of crisis insurance. They can make money so long as some things are trading. So because of all the commodities are trading at the moment, trend followers are having a very, very strong financial year.
So when we think about the 4 categories that exist within the portfolio, what are those categories, Killian?
So the first category is debt, fixed interest. So it's anything that makes sense that's delivering a real return. So we have a couple of allocations in there that are still giving us what we consider a real rate of return, and it's vehicles that are made up of loans. So it's not government bonds or anything like that. The second allocation is on the list is value equity, which is really any company operating that's not in the resource sector. So we aren't, we're kind of agnostic to which sector is valuable because we're not trying to predict. We're just saying, okay, this, it could be a automobile car part manufacturer. There's plenty of them out there, family run, operating really well in this environment. It could be an online dealer broker. So there's all these different things. We'll just look at it, treat every company as the same. We want them making cash flow. We want them little or no debt. And we want them cheap. We want them objectively cheap. So some of these companies are generating a 15% cash flow yield. The third part of our investment proposition is these trend following funds. And that's simply the difference between a trend following fund and a macro discretionary trader is imagine that you look up and you see all the positions that, let's call it Brevin Howard have, right? So Brevin Howard are like, they might be long bonds, they may be short gold, they may be long corn, all these different things. And they will make that decision sitting around in a committee saying, with corn, I think there's a problem with supply coming up. We should be long corn. Our guys, trend follower guys, you open up what their portfolio has and they may have the same positions, right? But the reason that they put on those positions because the market was starting to trend. So up or down. So they may have seen corn rising and it may have made a 30-day high. So they go, okay, we'll be allocated to that trend. They may see stock markets turning over and then they'll allocate a lot to that trend as well. So it really is a case of we're giving a large asset allocation to trend following funds simply to manage our hubris as well, because they don't care. They don't care what the macro people are talking about. They don't care what the new monetary system is going to be. They're just saying, this is trending, I'm on it, and I move my stop up. And they're great risk managers as well. And they're automated. So there's no management hubris there. That's certain set rules. It's systematic trading. And they have a great track record of delivering really strong returns. And the final part is commodity producers. And that, as we'll probably go on to touch, we've never had as much commodity exposure for a typical client portfolio since we set up the business. And that is in wholly part to what the opportunity set we're seeing from a bottom-up micro. So we were talking about kind of a typical value equity stock might give us 15% cash flow yields. Some of our mining companies with no debt are giving us upwards of 35, 40% cash flow yields. So to put that into context, if you took those companies private and bought all the outstanding equity and debt, you'd be making 40% of your money back in the first 12 months. And that's valuations. We have seen them in this sector before. I think you guys would, the channel would be aware, the end of 2015, a lot of mining companies are being given away. We're generating really strong cash flow yields. This is almost, in terms of sentiment and opportunity, it's similar to that timing. Mm-hmm. And so whilst we're seeing all this kind of like, there's a lot of people talking about inflation, I think the reason why we're able to pick up such bargains at the moment is because I think people really do believe that this is more transitory than, something that they may want to allocate to over the next 5 or 6 years.
Mm-hmm. So going back to, really drilling down into thinking about how you guys look at and analyze these companies, the equity category shows an interesting chart of a U.S. agribusiness, Seabord Corporation. And it shows us that it continues to act as proof over the medium term. Share price performance is driven by the compounding of the economic value of the firm. So can you explain how that compounding of the economic value of the business works?
Yeah, so in that letter, and that's our investment thesis, probably could be easily better explained in words. I'm sorry, my writing's a little bit laborious. But I think when we start, I'm not sure about you, but when you start off in the investment world, you start off as a trader, then you become an investor, and then you become a business owner. That's our mentality anyway. So the chart itself shows that if you invested in so this is company Seabord is a family-run business. It's the Bresky family vehicle. It started off back in the day. It was set up by a guy called Otto Bresky, and it was in milling. Then it moved into poultry. Then it moved into pork producing, where it still is now. It owns half of Butterball, which is the largest U.S. turkey producer, and it has a lot of other subsidiaries in there as well, energy production and whatnot. And you can see that the chart we shows the S&P has been a great investor. If you put £100 into the S&P over this time period, you got 1,500 out. what is so stark about this chart is that you see the share price is so volatile, right? And it's up and down. And you see the green line, which is what we say in the letter about the compounding, the real value of the company. That is your accumulated net profit. So that's the return on equity going up or whatever. So even in 2008, the company made a small profit. So the trend on that was quite shallow as it goes up. And the point is the share price is just going to fluctuate, right? But it will get to where that accounting profit gets to over the medium term. I think that chart for me sums up what Buffett was saying there about in the short term, the market is a voting machine. In the medium to long term, it's a weighing machine. Mm-hmm. And that is it. That's the investment. So if you find companies, and the really important thing on this is this compounding, this green line that you see as a kind of a base in which the share price goes up around. You've got to make sure that you're in a company that's an operating business. And we touch on it in the letter as well, because that green line can fall dramatically in certain situations. And with Lehman Brothers is one in which that green line just went, it starts off at 100 back in 1990. If it was Lehman, it goes up to wherever it goes, and then it goes down to zero. And Lehman had 3% of shareholder equity. So all it needed to do was have its assets changed by 3%. And that shareholder equity got wiped out. So you need to, what we try and ensure is that we are invested into companies that generate a lot of cash. They generate that green line from cash flow every year. So they're not generating it from changes in assets or liabilities or anything like that. Evergrande is a company that we touch on in the letter as well, because their green line was never made from cash flow. It was only made from repricing their book in Chinese property. And ultimately, when that property got written down, the company went insolvent. And the white line, which is the share price of Evergrande, went down to meet the green line, which was both of them met at zero. So they do track or whatever. And I think as a visual representation, Tim always says he wished he'd seen this kind of a chart 30 years ago, because it would save a lot of the angst of like when you're in a good company and it's continuing. I think there's probably a lot of people who are invested into say gold miners over the last 12 months, and they've seen this white line falling. And they're like, oh my God, is this because of X, Y, Z? Is there a problem with the company? And you get these quarterly updates. This is why we always say listed equity is so much, in many ways, easier than private equity, because if you own a private company and you get a really good quarterly update, you can't buy more shares because no one's going to sell you it, right? It's all privately held. They're like, no, I'm not selling. I'll buy it off you, thank you. Whereas a listed company, every day it's on sale. So if your company has a good quarter and the share price is falling, you can just buy some more. Now, in essence, you don't need to increase your risk if you don't want to, because if your company's operating well, that green line goes up, your share price will get there. Mm-hmm. It's just, if you're in a rush to make money, you're probably going to be bullied out of these stocks because it's falling and you're like, oh, well, people just need to see positive price returns quickly. Whereas if you're not in a rush, and we're running a wealth management business, so we need to make money for clients, otherwise they leave us, but that can't drive the allocation. So it's really about kind of explaining this to clients. This is what's going on. The share price is just out of whack. It's just crazy. But what another point is that everyone knows that the stock market is irrational, but they have a bounded irrationality about it. So it's like, yeah, we know it's irrational. We know it fluctuates a bit, but there's a point in which the share price, when it falls, is too much for somebody, some investor or some client or whatever. And there is that point where it's like, no, that's too much. I don't believe in this chart anymore. But that's just a lack of patience in itself, because I think Peter Condell, the famous value manager, said there's only 3 things needed to be a successful value investor: patience, and more patience. And this chart again just highlights that. Just like if it's not operating well, get out of it. Mm-hmm. If you're holding a company that has a lot of debt and you're afraid that green line may really suffer, get out of it. But if it's still operating well, at least stay in it, and if not, buy a bit more if you have that risk appetite. And that's where bespoke asset management comes in, because some clients won't have the appetite to buy more, and then some clients will understand that chart and be like, okay, this is what's going on. But on an aside, we had, in terms of some commodity companies we own, you'd show them this chart, you'd show the clients or your fellow investors, this is how it's operating. And rather than accept that the market's irrational, some people will say, is it a fraud? It's like, no, it's not a fraud. It's a listed company. It's, it's got banking relationships, it's whatnot. It's operating well. But that's where some people's minds will go rather than appreciate it's just irrational. It's just a little bit more irrational than you thought it would be. That's it.
Mm-hmm. And like when you say in the letter, you can look at the balance sheet of a company, look at how much debt they have and see where their returns are coming from. And that can give you a better idea of, theoretically, if they're a fraud or not, right?
Yeah, and I just think it's never. Buffett said something. I'm sorry to labor on Buffett or Connolly or whatever, but as you can imagine, if we're we were talking about this stuff, you brothers in arms when value managers have underperformed so much as value managers have recently. But Buffett talks about how it's quite simple value investing. I think he'd even call it just investing. It's quite simple. He's always surprised why not many people do it. They prefer to do the other thing, which is whether it's either growth or kind of predicting, momentum trading, for want of a better word. But it is quite simple. And it's never been easier because when Buffett started off, he would have had to, you weren't getting quarterly updates from your companies. You would have had to kind of like go and try and find the annual report. They weren't publicly available. All these different things. It's so easy now to get this information, but it doesn't seem to necessarily translate into more people doing it. It's, he said himself, it's people try and make something easy quite complicated. And I think that's fair. But I also do believe that you get out of the market what you want. And if you want sex, drugs, and rock and roll, this is not for you. Even if you saw a chart like this, you'd be like, nah, that's not for me. I want higher return than that. I want more volatility. But you can actually, with Bloomberg's one of our biggest expenses. But with that, you get these updates as soon as it comes out. The company reports. We get to see all these line items, cash flow from operations, and it just means you can never take. As much as we labor on the point, Bloomberg gives us this data. You can never take the data at face value either. You've got to go in terms of cash flow from operations. You have to. There's about 8 adjustments we make where it can look. I mean, as I was saying, Evergrande in the letter, it made cash flow from operations, positive cash flow from operations twice in the last 20 years, one of which was the last 12 months, right? And so if you're looking at it, you're going, well, it's suddenly become a good company. And it became a good, it had a positive cash flow from operations because it didn't pay its suppliers and it didn't pay its taxes. And so, but if you were looking at it, you're like, oh, it's had a good cash flow year, EBITDA's okay. And you're like, and it's about to go to the wall. Mm-hmm. So you've got to kind of like, there's about 8 adjustments we made to cash flow. There's about 3 or 4 we make to the EBITDA figure. And it's not rocket science. It's not like, we're not calling up anybody to try and find information that's not readily available. And it's a case, the debt level is so important in terms of risk because it can just mean that your company can't do the ebbs and flows of industry. It can't survive them. Because if something is we're talking about bounded irrationality in our understanding of the markets, but also if you think, well, the margin could fall to this, but it could fall a little bit more, And if you've got a bit of debt, it's just that last bit of margin for you. Like, we would have survived but for that. Whereas if you've got no debt and you've got no net debt, which is another important metric to look at, you can just serenely sail through. It's not to say the share price will serenely do anything for you. But again, that green line is what a lot of investors do not focus on. And they focus too much on the white line for us, for our purposes. But it's great. It means that, we can, in some ways, differentiate ourselves, but also just because no one else is doing it doesn't mean that we shouldn't be doing it.
Mm-hmm. So how do you get that metric? Is that a Bloomberg metric?
You can work it out yourself. We use the Bloomberg's return on equity, but it's simple. So say if you looked at it, if you're on the Seabord chart there, say at the end of 2009, whatever that figure, that data point is, you just get a 2009 annual report. Mm-hmm. And you just add up all the assets. And obviously people will talk about, well, there's tangible and intangible assets or whatever. Let's stay away from that conversation for now. And then you just minus the liabilities. And it'll actually be in any annual report, there'll be a little line called shareholder equity or members capital. There's a few different terminologies depending on the nature of the business or the jurisdiction. And it will give you that figure. So really it's the value of the accounting value of the company for the shareholders every year is reported. Now it's also reported every quarter, so you get a good data set on it. But yeah, it's I did the CFA or whatever, this wasn't part of, CFA teaches you about option pricing and all this kind of stuff. And just like, well, they could have done well to labor a little bit more on the inherent value of the company.
Mm-hmm. So when we're taking this growth of economic value versus share price model into account, is this what makes gold miners to you such an attractive sector?
Yeah. No, I wouldn't want to say that at the moment, certainly. Yeah. At today's prices and in certain, like, if you want to buy a commodity company and you want to hold it for like, you just say you want to hold it, you don't know when you're going to sell it, you like it, it's making a lot of money. You really want to be in a jurisdiction that you're comfortable about. I think Sudan recently, there was a military coup. I wouldn't want to wake up with a company in Sudan after that and just be like, oh, I wonder what the market are going to price it at. And I wonder, am I going to get my assets out of it? Because you're not. Like, mineral wealth is not coming out of a country for sure. But that said, yeah, we are, in many ways, because we've been allocating to commodities since we set up the business. And as I was saying, it's the highest allocation at the moment. And in many ways, you're like, isn't that great, right? Because you get the opportunity to have even more of a company or a handful of companies. You can have a bigger position in something that you think is really undervalued. So you like that. But you're also conscious as you're running a business, you want to keep clients happy with return. So there is that nature. They've come off over the last 12 months and they're giving us a cash flow yield. And these are some Western Australian producing companies, right? So we're not talking about exploration businesses. We don't buy exploration businesses. We leave that for people who have that risk profile, but also want to do all that work about what's the grade, what's the quality of the management getting in there? Have they got the permitting? Have they got the financing? Is it going to, for me, my history of those kind of investments is it's never as easy as you think getting that ore body out of the ground. And a lot of these really good ore bodies that geologists get really excited about, well, they're in Latin America or they're in Africa. And so therefore, for that reason, you wouldn't want to go in. But a lot of the ones all of the ones we're invested into in the commodity sector are giving us generally about 30 to 40% cash flow yield. So we take the company private. That's how much cash flow is hitting the company cash account on the next 12 months. And you're like, okay, this is objectively cheap valuations. And despite the share price falling, so this is the key in the Seabord chart or any chart that you put in there, share price falling, and when you've got the operations going up in the other direction, that's something you can take advantage of as well. Because in a lot of these gold miners, from the high of like September last year, they've produced now, because they reported end of September, they've produced 4 strong quarters of cash flow growth with no debt, good profits or whatever, at a time in which the sentiments just ebbed away from them. And that's just, you hear other people go, oh, well, is this manipulation? How stupid's everybody else? And all this kind of stuff. And it's just like, nah, it's that's your interpretation of it. But a chart like the Seabord chart there really just tells you this happens. Get over it. This is what, want to. Now, when we talk to clients, it's a lot more like, yeah, this is part of the process. Sorry. And we generally are sorry that you're experiencing this volatility for this company, but it is part and parcel of liquid equity investing. And it's a case you don't have to rationalize it, think that there's a boogeyman out there that's suppressing the price of your stock, anything like that. It's just the nature of it. So stay with it, buy more, keep an eye on those quarterly updates, because you could, as I'm saying, kind of like Evergrande start manipulating their cash flow. We actually felt a lot of oil companies in the final quarter of last year were running through their working capital for obvious reasons, because they were concerned if the oil price didn't recover, they were going to get some debt issues. So there is that. You just need to keep an eye on make sure it's actual operating cash flow that they're making. It's not shenanigans. Hopefully that explains that kind of green line in more light.
So how do you foresee oil prices, as you just brought up, affecting miners? If the margins are starting to shrink because of the price of, say, diesel, does this make them look less attractive, or might they be able to raise the price of gold to account for that?
Yeah, I've heard the argument a lot about, oh, well, the margins are going to be coming under pressure. Now, we've seen the most recent quarter was fine in terms of cash flow for our miners. They may have hedged a bit of their diesel exposure and whatnot. But ultimately, we've been in the commodity business and investing business so long now that you get the share price moves of a commodity, and then there's all this talk of there's a supply issue, there's a demand issue, all this kind of stuff. And you explain away these moves in the short term by talking about, so I've heard people say oil is going to go to 200. And I'm like, yeah, I mean, I'm not saying it doesn't go to 200, but I think all these commodities move. And I think there's charts there that show that broad commodity indices over the medium term move in line. And we saw that, we experienced that very painfully from 2012 to 2016. It was across it all. The whole commodity complex was falling. So the idea that people are saying oil has gone up to 80 or whatever. If you probably look at broad commodities since the Corona crisis, they've all kind of rallied at different periods. They've ebbed and flowed, but they've all kind of got to where they are now. The idea, if oil goes to 200 and gold stays as it is, obviously their margins get impacted. But we would be of the belief that anyone who's calling oil at 200 is probably just getting a little bit carried away with the recent price action on it, and is maybe buying into this narrative that comes from price moves one way or another. So I remember in 2015, it was a case of these, we were buying some commodity companies at that stage, and other analysts. We sat down with these two Bloomberg analysts, and we talked about Fortescue, the iron ore maker. And I mispronounced the company. I called it Fortescue or whatever it was. And they were all, idiot. I was like, yeah, fair enough. But we had just got the last update from it. And it had little to no debt. It was making really strong cash flow, and it was really dirt cheap. And so we were talking about, it's amazing how there's real value in some commodities, but like even big companies like Fortescue. And they said, no, iron ore, no, you don't want to be an iron ore. It's going to zero and all this kind of stuff. It's not the place to be. But maybe there's an argument when Bloomberg are writing articles about a commodity going one way or another, it's probably time to kind of like just maybe modify your exposure one way or the other to those stocks. And I think this oil theme has just got a lot of oxygen at the moment. So I wouldn't if it goes to 200 and go, you don't have to be a mathematician to know that is not good for any commodity producer. But then, as we show in the letter later on, these things do move in lockstep. So it's up to, if anyone's saying, listen, don't buy gold miners because of the price of oil, they've got to explain why oil goes to 200, and they'll come up to some supply and demand dynamic or whatever. But they've got to say that happens and the other commodities don't. And I wouldn't want to make that argument, because I can just show them a historic chart, and say, well, explain that away. Explain why they all went up, but maybe some went up for a year, the other ones followed up the following year. I think it's more, we've got to invest into something, right? And I think that's our way of saying, it could go to 200. That's a risk we're willing to take, and gold stays as it currently stands. But some of these Aussie gold miners are producing gold at 2,400. Sorry, they're selling gold at 2,400 Aussie dollar. They're producing it at 1,500, 1,400. And with no debt, do we want to? So the question is, do you want to be in commodities? Yes or no? We want to be in commodities. Do you want to be in what type of commodities? We want to be in cash producing commodities with no debt. Okay. What do you want to be in? We want to be in certain jurisdictions. Okay. And then are these expensive? Are we overpaying? The answer is no. And then we'll hold them until there's other opportunities out there. We're not forever commodity, investors. In many ways, our job would be a lot easier if we owned tech, or not because of historic returns, but there is an assumed riskiness with commodities that pervades our own industry and our own investors, but also clients as well. They can get very concerned about commodity as a risky investment, whereas we'd be like, have a load of the bond market or the property market. That's risky.
Mm-hmm. So when we think about, the coming commodity super cycle, as you guys were calling it in the letter, Killian, what are some of the reasons behind that type of thinking?
Well, I think from a lot of that is built into those kind of ratios that we discussed in the letter. So the S&P divided by the CCI index, for want of a better word, it has never been we took that chart back to 1960, I think 1970 maybe. Now, the 1970s, that ratio becomes way more in favor to a 10 times degree than it currently is in favor of commodities versus the S&P. So for us to get kind of conviction that this is something you want to be in, people call it a super cycle or whatever, it is that ratio that we're leaning on heavily to say, okay, commodities have never been cheaper versus financial markets, and financial markets aren't as expensive as bonds, say, right? So the S&P certainly isn't expensive as bonds. So S&P, then commodities have never been as cheap. Okay, can we buy cheap commodity producers? Because if you can't find cheap commodity producers, you should look at that chart again and say, is there something we're not seeing in this chart that's exaggerating commodity? Because obviously a lot of technology allows us to make a lot more commodities than we could do 50 years ago. So you've got to kind of like, that chart says, hey, can you find good cheap commodity producers? Yes, we can. So it's really a bottom-up narrative. Now, if you wanted, you don't need to go to the macro to think commodities for the next 5 or 6 years, 10 years is a better place to be than the S&P. That, I think that ratio gives you that indication. But if you want to go to the macro, the idea of, why do we want to be in commodities? And I think inflation is the answer here. Are we concerned about inflation? And I think in the nature of the size of the state in the Western world, to the degree to which it's got, the plans of what these politicians have in place, the role of the central bankers these days, which is more about wealth effect, it's more about all these kind of concerns about society. And it seems to be very unconcerned about inflation. And I think that's a narrative we would say, is that true? I'd say yes. I'd say that they have bigger concerns now than letting inflation rip. And, we FOMC meeting up tomorrow or whatever. We point in the letter, if they allow the interest rates in the UK, there's a Bank of England study. So take that with a pinch of salt, right? But the Bank of England study says that if interest rates get back to 2%, that will have a bigger impact on the mortgage market than in 2008, in what was going on in the depths of a global financial crisis. So are they going to, as we get inflation, as it is part of it was always part of our system. You print loads of money, you're going to get inflation. It seems to be getting out of hand. And the way historically in this monetary system that you quell inflation is by hiking interest rates. There is, because of wealth effect, which is not many people talk about the wealth effect angle, but these guys are obsessed with it. The central banks are like, okay, well, if they talk about, debt deflation dynamics or whatever, if asset prices fall, people don't spend, all this is what they truly believe. I think it's a lot of mumbo jumbo economics, to be honest, but what do I know? But either way, they do believe this, and they're going to be saying, okay, well, wealth effect is one thing. We don't want interest rates to rise because that will be more costly for the state to finance our huge, ever expanding debt. And they'd have to hike interest rates to really get control of inflation. And then the idea that they're going to be a small state, there's no Thatcher out there. So the idea that the government's not going to become, and the state is not going to become a bigger part of our economy in the next 3 or 4 years, I don't want to take that bet. So all these macro factors are saying, do you know what inflation is? So there's a confluence of a few things. There's a macro argument, as I've just displayed it. I could be wrong, right? But that's what we as a firm think. It's like, okay, these guys are kind of out of control from a fiscal point of view on the government side and the central banking side. So what they're doing here is it is 100% has led to a huge increase in monetary inflation. M2, whatever you want to call, like M0, kind of base money creation, broad money creation. I saw a stat there that 25% of all the dollars, digital, undigital, that have been created were created in the last 12 months. So, we can argue about price inflation or whatever, but there's monetary inflation. So it has happened. So are these guys going to continue along that path? We would say yes. So you've got this macro argument, you've got that chart showing the ratio argument, and then you're finding companies that if there's no inflation, if Australian gold stays as it is, if oil stays as it is, these companies are making a lot of money. So you don't even have to try and convince yourself, as we were doing back in 2011 as a firm, is we were saying, oh, well, gold's going up, silver's going up, copper's going up, iron ore is going up. These companies will do really well for us. They'll make a lot of money. And, it doesn't work that way. You can be wrong about your macro analysis. And I think to buttress that with, what I've just explained there, which is just our firm opinion, my opinion about what the macro outlook looked like. But if you can buttress it with, well, we have these really cheap commodity producing companies as well, isn't that great? And that's why I think, we could go back to anyone who was buying commodities at 2015, end of 2015. It doesn't take long for these things to change price. there's a lot of angst in the gold mining sector at the moment. I say, when are the beatings going to end? And then ultimately, it can change around very quickly because of the operations. The operations are so strong here that we don't believe that the share prices are going to continue to fall and even are going to stay. I think we'll be making new highs in a lot of these gold miners in short order. But I can only make that prediction or whatever you want to call it because of how these companies are so cheap and how they're operating. We've been in them before. Similar feelings to the end of 2015, and the share price reacted quite quickly.
Excellent, Killian. I think that's a great place to kind of wrap up. Do you have anything else you'd like to share with our listeners before we do?
No, not really. No. I think we haven't really touched on Bitcoin, but it's certainly, I guess, anyone listening, I think if you can learn any of our mistakes, it's by putting that macro analysis ahead of something that it's just buttressing it with something that really makes sense from a bottom-up perspective. And I just caution against anybody that is trying to invest their money for the long term in something that A, they don't understand, but B, they're trying to predict stuff happening. And if you can leave it with that as a kind of a salutary message of just be very careful of hubris and overconfidence in what is to come, because it can really change quite quickly, quite dramatically.
Mm-hmm. Excellent words there. Of course, Killian, you guys are available at pricevaluepartners.com. There's a bunch of Tim's writing up there. And of course, on Twitter at PriceVPartners. Anywhere else you'd like to point to?
No, we have a website, www.pricevaluepartners.com, and that's you might have said that. That's the only two. I think follow if you want to have a bit of a laugh. Follow Tim Price. He's quite animated, my business partner on Twitter, and he's always good for a laugh.
Excellent. Thanks so much for your time today, Killian.
Not at all.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.